How's everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I saw a great article in Bank Director that I wanted to bring everyone around the topic of selling the bank securities. Like, if you have underwater bank securities, is it always a great idea to sell those securities, or is it better to hold on to them sometimes strategically? So, this was a really interesting article that I came across that I went in here. So, this article is titled Selling bonds at a steep loss is not always a good idea. Over the last few years, banks have sold off underwater securities, but boards need to carefully evaluate whether this is really the right move. Now, I want to show everybody something first here. So I just want to point out, like, what is the issue at hand here. So, and look at this chart here. So this is called accumulated other comprehensive income for banks, also known as AOCI. Now, what has happened in the banking industry is the banking industry, since the Federal Reserve did their massive interest rate tightening, interest rate increase cycle a few years ago, it created in banks what are called unrealized losses in the bank's bond portfolios. And so the AOCI has been negative. And you can see here for a lot of banks out there, and you can see here we kind of hit our peak in the third quarter of 2022 at 300 and negative 385 billion. Then it's kind of been a little bit of a roller coaster, came back up to about negative 337 billion in the third quarter of 2023, and then has been kind of making its way down, but again, bouncing around a little bit, but it's still negative, at least as of the second quarter of 2025, it's still negative $185 billion. So it's getting better, but it's still an enormous problem in the banking industry. And I just want to read this to you here, everyone. So the market value of banks' bond portfolios continued to improve in the second quarter as interest rates kept falling. The firm expectations for Federal Reserve rate cuts are set to deliver another boost in the third quarter. Accumulated other comprehensive income, AOCI, which captures changes in market pricing for banks available for sale securities, otherwise known as AFS, improved sequentially in the quarter by 15.18 billion to negative 185 roughly billion dollars, according to data from S&P Global. Bond prices move inversely with rates, and the improvement reflected a drop in yields across medium-term maturities. Nevertheless, average interest rates across treasuries with 2-year to 7-year maturities, which encompass much of banks' bond holdings, fell 20 basis points from the end of the second quarter through September 5th. Average treasury rates across those maturities fell 17 points in the second quarter. So again, we're going back about a month ago. This article was from September 9th, so it is a few months back here. But again, I just wanted this just for purposes of giving everybody a little bit more context before we get into this main article here, just as kind of like what the situation was, what the deal is with this. Why are we talking about this basically today? So, okay, so now getting back here, is selling always the right thing to do? So, over the past 7 years, most banks have not delivered competitive performance to their shareholders. Since about mid-2018, KBW NASDAQ Regional Banking Index has delivered a cumulative 26% total return, while high-performing JP Morgan Chase & Company delivered a whopping 240%. Wow, that's pretty good. It's not just a regional bank problem. According to data from Bloomberg, there were 202 publicly traded banks between $1 billion and $20 billion in assets, of which, over this period, 54 have delivered negative annualized total returns. In addition, 118 have delivered below 10%, and only 30 have provided more than 10%. The Sub-Zero Group has accumulated a 34% cumulative growth in tangible book value per share, in contrast to the high-performing group's 127%. It is important to note that the cumulative tangible growth numbers above are unadjusted for losses that might be hiding in banks' held-to-maturity portfolio, also known as HTM, held to maturity. So again, you have two categories that make up that AOCI. You have available for sale, AFS, and held to maturity, HTM. If adjusted, the relative comparison could be even more profound. Again, the TBVPS, the tangible book value per share growth, is highly correlated with shareholder performance. To add suboptimal profitability metrics lingering in 2025, many boards are authorizing management teams to sell low coupon mortgage-backed securities, MBS, at steep losses to then restructure for improved book yields and income. While selling U.S. Treasury bonds or other short bullet cash flows at losses can be productive and wise, selling these specific discount mortgage assets is likely imprudent, particularly if banks then acquire new assets with the same overlooked risks that got them into the situation in the first place. The motivation is clear: profitability improvement. The income statement is usually the best metric for value, TB, tangible book value per share growth. The selling lower in exchange for higher book yields will help improve profitability metrics, but might not result in higher growth in future tangible book value per share. In fact, it's possible that the decision to reposition in today's environment could set up far lower growth in tangible book value per share in certain future interest rate scenarios. Even more concerning, those scenarios happen to be the ones that industry participants expect will happen. The current drag on long-term bank returns stems partially from decisions made in 2021 when liquidity was abundant and the consensus was rates would remain below 1% until at least 2024. Banks needed income to make 2022 budgets look acceptable. Most did not properly respect the potential for multiple future interest rate scenarios and piled into things like 20-year 2% MBS with the 5-year average life and 50 basis points more book income than the 5-year Treasury. So Performance Trust is among the few on record in 2021 urging against this decision, as respect for multiple future scenarios made it clear that the MBS choice was exposed to significant option risk in ratings and rates up and rates down in comparison to the Treasury. So again, just to kind of explain that in parlance. So what happened was banks basically went long in their bond portfolio because they saw interest rates staying way down at 1%. They did not see any rate increases coming. They did not see the inflation that was unleashed by the Federal Reserve pumping all the money that they did into the economy. They did not see that massive inflation and therefore didn't see the massive Fed tightening. So I think that, and again, the Federal Reserve hiked the interest rates 11 times in just very short period of time. It was one of the most aggressive rate tightening schedules that we've ever seen in the Fed's 110 plus year history. So again, bankers were just not ready for that. So from 2021 to 2025, rates went up by roughly 250 basis points. What I just said, right? That 5-year Treasury bond from 2021 is now a 1-year Treasury maturing in 2026 with a 2-point loss. The 5-year average life of MBS 4 years later has extended to a 6.3-year average life, with a loss of 13 points, according to data from Bloomberg. In 2021, we were striving to fix 2022 profitability, while in 2025, the same mindset around 2026 is driving many repositioning decisions. In search of the highest replacement yields, many will be drawn to the 2025 version of the same assets that created this problem in 2021. Par-priced coupon MBS with significant option risk. In contrast, by holding on to the discount MBS purchased in 2021, you will avoid a reduction in regulatory capital, and our analysis suggests that across a range of rate scenarios, the accumulated other comprehensive income, the AOCI, accretion, combined with the low book yields that come with holding the assets, have the potential to deliver better tangible book value per share growth than chasing higher replacement book yields that won't have any AOCI accretion and are saddled with risks if rates fall or rise. For the same reason we advised against par-priced MBS in 2021, we advised against investing in current coupon MBS today, such as the 20-year 5% or 30-year 5.5%, as these will be attractive only if rates remain largely unchanged for the coming few years. There is a good chance loss selling MBS will be on your board's next agenda. Certain assets should be marked as clear to be sold. Others, like discount MBS, should usually be kept, especially if the asset being considered for replacement carries the same types of risks that created today's issues back in 2021. Repositioning can be wise, but it can be difficult to evaluate the decision unless we examine it through a lens that provides clarity around multiple future interest rate scenario growth in tangible book value per share. So again, very interesting article. Really looking down again, very technical here in terms of really breaking down and really get into the different bond types, bond options, particularly as it revolves around MBS. So, but I think the author makes a very valid point here. That is, don't kind of repeat some of the bad decisions that were made in the past. Think through and really look at what's really going on there. Like it says here, from 21 to 25, rates went up 250 basis points, and that 5-year Treasury bond from 2021 is now a 1-year Treasury maturing in 2026 with a 2-point loss. The 5-year average life MBS 4 years later has extended to a 6.3-year average life with a loss of 13 points, according to data again from Bloomberg. Now, so again, sitting and holding this thing for a while may actually pay off. You may see better performance out of your overall AOCI, which again, that's what you're looking for. So again, I think they just make up a very big point. Just analyze your situation, really look at various different interest rate scenarios. What happens if rates go up, if they go down by 100 basis points, 200, 300, 400 basis points. What does that look like? How does that, and how will that help you to make the best bond decisions out there? Like, what do you like? Do you think the Fed is going to be really aggressive in cutting rates? Do you think they're going to bring rates down by 200, 300 basis points? Or do you think that, they've made 50 basis points cuts and maybe we're done, at least until Jeremy Powell's gone? I don't know. We'll have to see. But again, I thought this was a really good article, really trying to provide some good advice to banks in trying to make some of their investment portfolio decisions, and hopefully trying to get us out of this mess and trying to fix this issue for banks, which has been hanging over banks' heads for the last, two plus years now. So again, but we will see what happens. But I will wrap this up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you for listening. Have a great day out there, and I'll see you again real soon.